Hello everyone, welcome back to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us discuss today issue of shares. Issue of shares. See, it is starting from the initial stage of the company. Without capital, they can't run the business. Capital can be it from the owners, that is owners invested own money capital, only capital, we will call that as a capital. When they raised the fund from the general public by issuing shares, then it is called as share capital. Share capital, it is not collected in bulk. Then what is share? A share is a smallest unit in which capital of company is divided. Now, what is the smallest unit in which capital of the company is divided? You have seen share capital, shares of rupees 10 each. Per share it cost 10. If you issued 1 lakh shares, then you are collecting, what is your capital? Your capital will be 10 lakh. 1 lakh into 10, you will get, totally you have collected 10 lakh rupees. This is your share capital. Unit of equal value. Here, the equal is share. Value is face value. This is, here it is there, no? 10 each. This 10 rupees is called as the face value. And when we talk about the companies, here we are talking about the public companies. Right? Now, issuing process. How these shares are issued? That issuing process, the company issues the prospectus. Prospectus is advertisement for the company. It contains complete details of the company, which being an investor, what details they'll expect to see in the prospectus, those details will be mentioned in the prospectus. It is a document containing the details of the company. What are all the details? You are an investor, right? You want to invest in some XYZ company. If you want to invest, before investment, you are analyzing the companies, right? So, how you are analyzing? Only present data, is it enough for you to analyze? No, you need past records also. So, the prospectus contains the past records, and you want to know who are all the board of directors. Because they are the decision makers, right? So you want to know who are the directors. Then who are all the present investors, already invested in the major investors in the company. Because I am investing money for today to get tomorrow's return, right? So the tomorrow's return is uncertain, but still I need to take a precautionary measures. I want to know company details in detail, right? That is why you are checking the prospectus will contain all these details. Then reason for raising the fund, why they are raising the fund, whether they are expanding the business or in for the production of any new products, that reason should be mentioned. Then the investment we are doing by expecting the return. So what is that expected rate of return? The rate to see. And at the end of the application form, the prospector application form will be attached for the potential investors. Here we are talking about potential investors. Potential investors, why we are telling? Because they are the persons one who are ready to invest. They are thinking about investment. That is why it is called as investors. And when the investors application is attached, so the application money they will pay. Application money they will pay. They'll get a 3 days time to pay the application money. What is application money? Application money is a part of the face value. Part of the face value. This is our face value. In this only the application money is included. It is for the potential investors. They will deposit application and with the application money within the 3 days. And application money will be collected through bank account. All the transaction bank only. But here you will open a separate account for the application. Separate account for the application to receive the application money. It is called as escrow account. Escrow account. Why it is separately application money is collected? Now XYZ company offered 1 lakh shares. 1 lakh shares. They offered 1 lakh shares. There are cases. First case, application money. Application, they received 1 lakh application. 1 lakh applications they received. Then there is no problem. 1 lakh application they received. So because they issued 1 lakh, for same 1 lakh they received. Then there is a no problem. Then in second case, application money, they received 1,20,000. 1,20,000. This is also not a problem. The excess, whatever it is there, they will return. In case 3, they received 93,000. And case 4, they received applications 86,000. 93,000 is also not a problem. Because we need to meet our minimum subscription. We need to meet our minimum subscription. What is minimum subscription? Minimum subscription is if the number of applications received by the company are less than the share offered for subscription, we need to verify whether it is meeting the minimum subscription or not. Minimum subscription means 90% on the issued. 93,000, this is reached, but 86,000. Why? What happens if in case they are not meeting the minimum subscription? Then they have to refund entire money. They need to refund the entire money. Who made this rule? 90%. Now, for minimum subscription, we are following the rules of, first one is Companies Act 2013. Companies Act 2013. Then another is SEBI, Security Exchange Board of India. The SEBI made rule that 90% subscription should be met. If they are not meeting this 90%, they need to refund the entire amount whatever they have received. Then what Companies Act says? The Companies Act says the minimum subscription, it is stated in the prospector of the company. It is stated in the prospector of the company for different specified purposes. For different specified purposes. And here all the listed companies under SEBI, listed companies under SEBI, they follow this rule. They have to follow SEBI rule. Now, application money, I told it's a part of the face value. Now, share capital will be called as authorized, issued, then subscribed. Authorized share capital, issued share capital, subscribed share capital. Authorized share capital will be mentioned in the memorandum of association under capital clause. Capital clause. And here this is also called as registered capital. At the time of registration of the company, they need to mention what is the shares they are going to issue in future. That is the authorized share capital. In the balance sheet, we are recording authorized share capital, but we are not considering for the totaling. That you need to remember. Now, example, in future 1 lakh shares they are issuing at rupees 10 each. Then it will be 10 lakh. 10 lakh share capital. The whole 1 lakh also they can issue, or part of this. That is why issued capital is the part of the authorized share capital. Now 50,000 shares you issued. 50,000 into 10. 5 lakh. Then subscribed capital is the, maybe whatever you have issued, sometimes you will not get complete subscription. 90% subscription you will get. It can be 90% or 100%. If it is 100%, whatever you issued, you received, then it is called as fully subscribed. Fully subscribed. If it is 5 lakh, I told, no? 5 lakh, less than that 4 lakh if you received, it is called under subscription. Under subscription. If you received more than the actual capital, then it is called as over subscription. Over subscription. Is it clear? Now, the application money, the face value. The face value, 10 rupees is there, no? You are not receiving together. 10 rupees not, you are not collecting in a single go. Then how you are collecting? You have stages. First you will collect application, 3 rupees. In 10 rupees, part of the face value. Then on allotment, 3 rupees. On first call, 2 rupees. Then final call, it can be second and final call, 2 rupees. 10 rupees. See, 6 plus 4, 10. This 10 rupees you are collecting as application money, allotment money, first call money, second and final call money. Now, how you are issuing shares? Shares will be issued to the, in 4 forms you can issue the shares. Issue of shares. First one will start with the owner, because owners is the person one who collects the capital. When you are issuing shares to your proprietors, proprietor or promoters, Then the entry is incorporation cost debtor to proprietor's account. Proprietor's account. Then the second entry is proprietor's account debtor to transfer it to the capital account, share capital account. If you cancel proprietor account debit and credit here, then the entry remaining is incorporation cost account debtor to share capital account. If you are issuing to underwriters, underwriters are on behalf of the company. Underwriters issues the shares to the general public because company should get minimum subscription. So what the company can't go and sell the shares in the market. So what they will fix, they'll fix the underwriter for the commission. Underwriters will either they will issue to the public or they themselves will purchase. That is why underwriters they will issue to the underwriters. If they issue to the underwriters, underwriters are working for commission. So underwriter commission account debtor, underwriter commission account debtor to underwriter's account. Underwriter's account. To transfer this to share capital account, you are debiting underwriter. You are debiting underwriter account debtor to share capital account. Share capital account. This is the entry. If in case you are issuing to the underwriter. In case if you are issuing to the vendors. If you are issuing to the vendors, from vendors, issue takes place through assets or purchasing the running business. Now, in case of asset, you are debiting all asset account debtor to vendors account to transfer this to capital account. You are debiting vendors account. Everywhere entry is same. Just one single change. Vendors account debtor to share capital account. Share capital account. Then in case of running business, if you issued at premium, then what is the entry? Entry is vendor account debtor to vendor. In case of premium, vendors account debtor to share capital account. Always you are crediting the securities premium account. Remember this, securities premium account. This is the entry. If in case you are running business, how you are valuing the value of the business? The value of the business is total assets minus liabilities. You will get the value of the business. It is called as purchase consideration. The entry is asset account debtor to liabilities account to purchase consideration account. PC means purchase consideration account. Now, in case you have received excess, means profit on the your business sold, then how you are recording that entry? Now see here, asset account debtor, goodwill account in case of profit, goodwill account debtor, to liabilities account, to purchase consideration account. This is in case of profit. In case of loss, what you will do? Entry is asset account debtor, to liabilities account, to purchase consideration account, to capital reserve, capital reserve account in case of loss. This is the entry. Shares can be issued at par and premium. Shares can be issued at par. Par means on the face value. No changes. Rupees 10 means 10 rupees only. You are issuing the shares. It is called the shares issued at par. In case of premium, say equity shares will be issued at par or premium. Premium, this you are always you are debiting, you are crediting. Sorry, you are crediting. Always you are crediting securities premium account. Securities premium account. Securities premium account. How you are finding the number of shares? Number of shares, amount payable to vendors divided by value of share. Of shares. This is it. Now let us understand the entries of journal entries for if you are issued to the public. First entry, we have already know that share the face value will be collected in 4 different stages. So everywhere you are recording 4 entries. 4 entries, right? So what are those entries? The first entry for the application money. Application money. Application money. First entry is bank account debtor. Bank account debtor to share application account. Share application account. Bank account debtor to share application account. This is the first entry you are passing for the application money received. You have received. You debited the bank account and credited the share application account. Now, you are transferring this share application money to capital account. Right. So, to transfer, you are debiting share application account. Share application account debit debtor to share capital account. Share capital account. You are crediting. Then allotment. Allotment. Allotment means you are informing, you are requesting shareholders to pay the money. Allotment. So first entry is the due entry. You need to show the due entry. Due entry is share allotment account debtor to share capital account. This is due entry. Then receipt entry is you are debiting bank account debtor to share allotment account. If you cancel share allotment account, see here debited, here credited. This account is closed. So what is the account remaining? Bank account debtor to share capital account. Here also share application credited, here you debited. So bank account debtor to share capital account. Everywhere it is coming. You are transferring to capital account. Is it clear? Understood? You should never ever by heart the journal entries. You need to understand. Then third stage is for share first call account. First call account debtor to share capital account. This is due entry. Then receipt entry is bank account debtor to share first call account. See, first call if you cancel, bank account debtor to share capital account. Everywhere it is coming the same, right? The next entry is for the final call. Final call. Share second and final call account debtor to share capital account. Bank account debtor to share second and final call account. These are the entries. I hope you all understood. In the upcoming classes, we will understand the problems also. Thank you for watching. Have a great day.